everyone, welcome to the new semester now. Now, very first of all, in this semester, you are not going to have the subject of accountancy. Instead of accountancy, the name of your subject is financial reporting. I repeat, instead of accountancy, the name of your subject is financial reporting. And within financial reporting, today we are going to start with the chapter of earning per share, which is governed by Accounting Standard 20. Before I take in detail with what is earning per share, let us first understand what is this subject financial reporting. Okay, against accountancy, what is this subject financial reporting? As the name suggests, financial reporting means you have to report your financial information, profit and loss account and balance sheet, to the shareholders and debenture holders and public in general. Okay, all the stakeholders in the company. So this subject is basically going to deal with the standards and rules and regulations, how to report the things to the shareholders so that there is no manipulation, correct information goes to the shareholders and public and debenture holders and other stakeholders in general, and company also does not get affected in the stock market because of wrong reporting. So in this subject, basically we are going to study the standards of financial reporting, the rules and regulations of financial reporting. Okay, financial reporting is a disclosure of financial results to the stakeholders about how a company is performing over time. What are topics we are going to study in this subject? Basically, it covers the standards and disclosures on following topics: interim financial reporting, how to report your part of the interim financial year, means half year, quarterly reports. Okay, quarterly financial statements, how to report to the shareholders. Segment reporting, so in case if you have different segments, departments, branches in your organization, how to report the segments, what are the rules to be followed for the same. Earning per share, okay, this is very helpful for analyzing the performance of the company in the stock market. Employees benefits, wages, salaries, etc. What reporting standards are to be followed. Mutual funds and value added statement. These are all your topics in this subject, and these chapters will be covered in your financial reporting subject also, out of which today we are going to start with the chapter of earning per share. Okay, all of you take out your notebooks and give the heading financial reporting subject, and the name of the chapter is earning per share. Now let us understand what is the meaning of earning per share. The concept is quite simple. Earning per share means, earnings means what? Profits. Okay, earnings means profits. Per share, so total profits divided by number of shares. The simple concept is total profits divided by number of shares is earning per share. Now this earning per share we calculate from the point of view of equity shareholders. I repeat, earning per share we calculate from the point of view of equity shareholders. So all of you take out your notebooks and write down this brief introduction. I repeat, all of you take out your notebooks and write down this brief introduction, that earning per share is calculated from equity shareholders' point of view. As the name suggests, earning per share means the profits of the company on per share basis. Okay, wherever required you can pause the video and write down the things. So this is a basic concept of earning per share, profits of the company on per share basis. First of all, you need to understand that equity shares are of two types: existing and potential. Existing equity shares are those shares which appear on the face of the balance sheet. So if in your balance sheet liability side we have 5 lakh equity shares of ₹10 each, you can say existing equity shares are 5 lakhs. Okay, so existing equity shares are those shares which appear on the face of the balance sheet. Now potential equity shares means what? It's a new term, understand it first. See, you understand the word potential? Potential means capability. So potential basically means what? Capability. Potential equity shares are such securities which have potential capability to become equity shares in future. Okay, they have potential or ability or capability to become equity shares in future. For example, convertible debentures, convertible preference shares. Right now they are preference shares, right now they are debentures, but they have potential of becoming equity shares in future when the maturity period arises. So such securities, convertible debentures and convertible preference shares, are called potential equity shares. Look at it. All of you can write this in your notebooks, okay? Existing equity shares are the equity shares appearing in the existing balance sheet, and potential equity shares are those securities which have potential of becoming equity shares in future. For example, convertible preference shares, convertible debentures, share warrants, ESOP, employees stock option plan, etc. Even employee stock option plan means in future employees have an option to get the equity shares of the company, so they are also going to become equity shares in future. Now, based on the types of equity shares, there are two types of EPS, basic EPS and diluted EPS. So in this chapter, we are going to cover two topics, basic and diluted EPS. However, in today's lecture, we are going to discuss basic EPS in detail. But what are these two things? See, as we discussed, there are two types of equity shares, existing and potential. Basic EPS is the earning per share which is calculated on the basis of existing equity shares. Okay, basic EPS is the EPS which is calculated on the basis of existing equity shares. Whereas diluted EPS is the EPS which includes existing also and potential equity shares also. Diluted means not only potential, existing plus potential is also taken into consideration. Look at it. Basic EPS is calculated considering only existing equity shares, and diluted EPS is calculated considering existing as well as potential equity shares. Now understand why we call it as diluted EPS. All of you understand this concept in detail. Why including potential equity shares when we find the EPS is it called diluted EPS? Suppose presently these are the shareholders of the company. Count them. You can see 3 people sitting in front and 2 on the extreme ends. 5 people are there. Presently there are 5 shareholders of the company. Now potential equity shares means convertible debentures, preference shares, share warrants, ESOP which will become equity shares in future. Let us say we have debentures in the company, convertible debentures, and they will get converted into equity shares in future. So let us say after 3, 4, 5 years when they get converted into equity shares, what will happen? These debentures will get converted into equity shares. So can I say number of equity shareholders will increase? Like presently there are 5. Now see on the right side, when debentures get converted into equity shares, we have 1, 2, 3, 4, 5, 6, 7, 8. 8 shareholders of the company. Okay, just a simple example to explain you the concept I am explaining. Before the conversion of debentures, there were 5 equity shareholders. On the right side, after the conversion, there are 8 equity shareholders. Now, presently, the earnings of the company, profits of the company are divided and distributed amongst 5 shareholders. In future, the same profits of the company will get divided and distributed between 8 shareholders when debentures get converted into equity shares. So, can I say existing when you distribute the earnings between 5 shareholders, each shareholder will get more in proportion. In comparison to in future, same 5 shareholders will get less in proportion because they will have to share their pie with 3 more people. Presently, the earnings are divided in 5. In future, they will be divided in 8. So, in future, when the earnings are divided in 8, existing 5 will have to share some pie of their profits, some share of their profits with the remaining 3 also. Which 3? Those debentures which are getting converted into equity shares. So, will the share of existing 5 shareholders in earnings decrease or not? Yes. Because it will decrease, it is called diluted EPS. Dilute means decrease. Okay, here dilute means decrease. So diluted EPS is the EPS calculated considering existing as well as potential equity shares. And why the name is given diluted? Because when potential equity shares get converted into equity shares, the existing shareholders' earning per share will go down. In fact, overall earning per share itself will go down. Since it goes down, it is called diluted EPS. This is a basic funda. Okay. However, in today's lecture, we are going to study in detail what is basic EPS. Give the heading in your notebooks, basic EPS. Okay, topic 1 in this chapter, basic EPS. As I said to you, what is earning per share? Profits on per share basis, so total profits of the company divided by total number of shares. But which profits of the company? Those profits which are available or attributable for equity shareholders. Means first from the profits of the company. Equity shareholders have the last claim on everything. They are the main owners of the company. So first from the profits of the company, you give interest to debenture holders, you pay interest on loans, then you pay taxes to the government, then even you give dividend to preference shareholders. Okay, why do we call preference shareholders as preference? Why the word preference is used? Because they have two preferences or priorities. One is in getting the dividend and second is in getting the return of capital, money, when the company goes into liquidation. Okay, why the preference shareholders are called preference? Because they have two preferences. They get the profits, dividends before equity shareholders, therefore they have that preference. They get the money back, capital back before equity shareholders when the company goes into liquidation, therefore they are called preference. So why the preference are called preference? Because they have these two priorities. So from the profits of the company, first you will give preference dividend, then the left out amount, more or less, whatever is left out, it may be huge amount also, it may be less also compared to what others got, goes to equity shareholders. So concept is quite simple. Earning per share, so earnings divided by number of shares. But which earnings? The profits which are available for equity shareholders after paying everyone else. Interest on debentures, interest on loans, government taxes, preference dividend, after paying everyone else, whatever is left out are the profits available for equity shareholders. And then you divide that by number of equity shares. Because we are talking about which earning per share from the point of view of equity shareholders. So note down this formula in your notebook. All of you have to write it in the notebook. Basic EPS is calculated as follows. Basic EPS is equal to net profit or loss for the period attributable, means available to equity shareholders. As I discussed, which profits are available to equity shareholders after paying to everyone else, divided by weighted average number of equity shares outstanding during the year, means divided by number of shares. Now, numerator, though we understood that net profit or loss attributable to equity shareholders means after paying debenture interest, taxes and dividend to preference shareholders, left out is available for equity shareholders. Now a question may arise, why we have not simply written the denominator as number of equity shares? Why we have used so huge and heavy words, weighted average number of equity shares outstanding during the year? What is this so lengthy about to be used and just not simply number of equity shares? Okay, you would have studied this ratio in financial management subject also in the last semester. Earning per share must have been studied as one of the ratios, right? So why we use weighted average, understand it. See, numerator, that is profit. Okay, numerator, that is profit, is a flow concept. Flow concept means we are talking about which profits? Are we talking about the profits which we earned on 31st March? Are we talking about the profits which we earned on 31st March? No. We are talking about the profits which we earned between April to March. Flow concept. The profit is not earned on a particular date. It is earned during a particular period. Which period? Between April to March. So between April to March, the profit is flowing. The profit is being earned. So numerator profit is a flow concept. Okay. Numerator profit is a flow concept. Profit is earned between April to March. Between April to March. But denominator number of shares is a static concept. Number of shares as on 31st March on the balance sheet date. Now, you cannot compare the profits between April to March with the number of shares only on 31st March, because maybe in between the year on 1st of October the shares might have been issued, maybe on 1st of December the shares might have been issued, maybe on 1st of February shares are purchased back, also buyback of equity shares takes place. Several transactions of shares may also take place during the year. So shares being a static concept, we have the number of shares on a particular date, How do we make it a flow concept? With the help of weighted average number of equity shares during the year. Means what happens when you issue any shares in October, you'll assign that the weight of 6 months, because we are using that money from October to March, 6 months. Whatever shares are lying in the beginning of the year, 1st April, from 1st April to 31st March, you'll give the weight of full 12 months. Okay, if you are using any buying any shares back on 1st February, then the number of shares decreases, and they will be used only for the last 2 months of the year, February and March. So that weightage is given according to the time period. So by taking, instead of number of shares, weighted average number of equity shares outstanding during the year, what are we doing? We are converting the static concept of number of equity shares on a particular date into a flow concept during the year. So now both are comparable. Numerator is also profit or loss during the year. Denominator are also number of shares during the year. So what formula we have to use for basic EPS? Simple concept, very simple formula. Actual concept is earnings divided by number of shares. Earnings, but which earnings? Profit attributable to equity shareholders divided by number of shares. But which number of shares? Flow concept, weighted average number of equity shares. Now let us understand these two things in detail. How to find the profits attributable to equity shareholders, and how to find weighted average number of equity shares outstanding during the year. Give the heading in your notebooks: net profit or loss attributable to equity shareholders. As we discussed, which profits are available for shareholders? You pay to everyone else, and then whatever is left out is available for equity shareholders. So we directly start with profits after tax. Write down this in your notebooks: profit after tax, and 3 crosses X means the amount of that. Okay. Profit after tax means interest is also paid, government taxes are also paid. Now, again from this profits after tax, who has the first preference or right on the dividends of the company? Preference shareholders. So we will subtract preference dividend. Now here again there is a glitch. We have two types of preference shares: cumulative preference shares and non-cumulative preference shares. Now what are cumulative preference shares? Okay. What are cumulative preference shares? Cumulative preference shares are those preference shares where the dividend gets accumulated in the year of loss or in the year of less profits. Means if in any year company earns less profits and is not capable of paying the dividend committed to the preference shareholders, and they pay less dividend, then that remaining dividend will get accumulated. And in the year of loss, if company is not able to pay the dividend to the preference shareholders, that dividend also gets accumulated. And then in future, whenever company is in a position to pay the dividend, first it will have to clear the backlog of past dividends. Then only it can pay dividend of that year. And until all the past year's dividends are paid to preference shareholders, nothing will be paid to equity shareholders. These are which preference shares? Cumulative preference shares. So suppose in year 1 company incurs loss, the preference shares dividend gets accumulated. Year 2 loss accumulated, 3 loss accumulated. Now 4th year company earns profit, then first it will have to pay dividend of past 3 years, accumulated dividend. After that, still profit left out, pay the 4th year dividend to preference shareholders. Still profit left out, then you pay to equity shareholders. This is the special feature of which preference shares? Cumulative preference shares. So what we will be doing is, write down this in your notebook: less fixed dividend on cumulative preference shares. Now what is this fixed dividend? If we have 12% cumulative preference shares, we will minus 12% dividend only, even if because of less profits company might have proposed and paid 8% dividend only in the current year. Because at 4%, company has to pay it in future before anything goes to equity shareholders. So if you have cumulative preference shares in the balance sheet, you will minus which dividend? Fixed dividend. Whatever may be the proposed dividend, it may be less also, but you will minus which dividend? Fixed dividend. So write this in your notebook: fixed dividend on cumulative preference shares. And proposed dividend on non-cumulative preference shares. Non-cumulative means nothing gets accumulated. So even if you have 12% preference shares, but 8% is proposed, then 8% is the final amount. Forget 4%. You will not get in future. Only 8% will be paid in the current year. So how will you subtract the preference dividend? Fixed dividend on cumulative preference shares and proposed dividend on non-cumulative preference shares. So if we have 12% cumulative and 11% non-cumulative preference shares, in case of cumulative will minus 12% only, whatever may be the proposed dividend, 8 or 9%. But in non-cumulative, if proposed is 8%, then in spite of being 11% preference shares, you will minus only 8% dividend because they are not going to get the remaining 3% dividend. Okay, so this is very important point to be noted. From profits after tax, we subtract preference dividend, then we get the profits available for equity shareholders. But within preference dividend also, on cumulative preference shares, you subtract which dividend? Fixed amount of dividend committed to them. And in non-cumulative preference shares, you minus which dividend? Proposed dividend. And then what we get is profits attributable to equity shareholders. So every one of you note down this in your notebook. How do you find the net profit or loss attributable to equity shareholders? From profit after tax, we will minus fixed dividend on cumulative preference shares, proposed dividend on non-cumulative preference shares, and what we get is profits attributable to equity shareholders. Now we understand the denominator. So numerator is clear in the formula. What is net profit or loss attributable to equity shareholders? Now what is the denominator? Weighted average number of equity shares outstanding during the year. Give the heading in your notebooks. Weighted average number of equity shares, in bracket WANES, W-A-N-E-S. W weighted, A average, and number of E equity, and S shares. How do we find this weighted average number of equity shares? Flow concept. Remember, I explained you just now. Number of equity shares, static concept, is made a flow concept by finding WANES. Make this table in your notebook. 1, 2, 3, 4, 5, 6. 6 columns table. First column write date. Second column write particulars. Third column write number of shares. Fourth column write balance. Fifth column write weights. And sixth column write WANES, weighted average number of equity shares. Pause the video and make these 6 columns. 4-5 lines format. Okay, just to understand how to find WANES. Date, particulars, number of shares, balance, weights, and WANES. I hope you all are done with the formats. Now what we will be doing over here is, in the opening balance of shares, if any shares are issued for cash, we will add to get the balance amount. Okay, this fourth column balance, how will you get? In opening balance of shares, any issue of shares will be added. Bonus shares will be added. Convertible debentures which are converted into equity shares will also be added. However, buyback of shares will be subtracted to find the balance. All this you write it in your notebook. Issue of shares will be added in finding the balance. Bonus shares will be added. If convertible debentures or preference shares, anything are converted into equity shares, they will also get added. Buyback of equity shares is the only thing which results in decrease in balance of shares, that we would minus. Weights will be assigned to time period. Time period will depend on the date column. Okay, weights will be assigned to time period and time period will depend on date column. So you all can pause the video and write down these details. How would we find the weighted average number of equity shares? By making these columns. Particularly in the number of shares, how will we find the balance? Issue of shares, bonus shares, and convertible debentures or preference converted into equity shares will get added. Buyback of shares would get subtracted. Weights will be assigned to the time period the shares are there in the company. Okay, from the date of issue up till the end of the year, whatever is the time period we are using the shares money in the company, that time period will be given as weights. Now we understand few concepts related to these weights. So pause the video and note it down, then we take up the next part. Okay, and if not done, you can keep the video paused. Once done, you play the video. So important notes we will write. First note we have to write regarding bonus shares. Now understand the concept first, then I'll make you write it. See, whenever you issue shares for cash in the public, whenever you issue the shares in the public, you get money against those shares. What do you do with that money? What do you do with that money? That money you invest in the company's business. What happens once you invest that money in the company's business? You start earning profits from that. Means whatever shares are issued in the public for cash, from that shares earning develops, because that money itself is invested in the business and the company start earning profits from the same. So every time a company issues shares in the public, its earnings are going to increase. Is it or not? Every time a company issues the shares in the public, its earnings are going to increase. But if the company issues bonus shares, listen carefully, if the company issues bonus shares, is the same going to happen? Are the profits of the company going to increase by issuing the bonus shares against the shares issued in public for cash? No. Bonus shares means the company is issuing the shares free of cost to the existing shareholders from the reserves of the company itself. Is the company going to get any money? No. Is the company going to invest anything in the business? No. Means in the formula of basic EPS, numerator profits attributable to equity shareholders don't increase. But in the denominator, by issuing the bonus shares, number of shares increase. Numerator profit does not increase, but denominator number of shares increase. Now, bonus shares, company is doing something good for the shareholders. By giving the bonus shares, the shareholders' wealth increases. Because immediate effect will be in the stock market, the price will fall down, but again the price will come back to the same level. Overall, the number of shares are more with the shareholders, so their overall wealth will increase. But what happens by doing this something good for the shareholders? Company's impression is going down in the form of earning per share, because profits remain same, denominator number of shares increase, so EPS will fall. Without any fault of the company gets penalized in the form of earning per share. And if company discloses that earning per share to the shareholders, they will feel last year the company's EPS was more, this year the company's EPS is less. Company's profits have gone down. In the stock market, negativity will be created. People will start selling company's shares. Company's overall impression will get affected. Without understanding that why the EPS has gone down, not because the profits have gone down. The EPS has gone down because in the denominator, number of shares have increased by issuing bonus shares. Here, financial reporting plays an important role. Here, as per AS 20, Accounting Standard 20, the chartered accountants say that company should not be penalized for doing something good for the shareholders. So what will the company do? If company is reporting the information for 2 years, 1920, 2021, in the year 2021 company issued bonus shares, then what would happen? 1920's EPS more, 2021's EPS less. That will show wrong impression about the company. So chartered accountants AS 20 says that, Accounting Standard 20 says that the bonus shares which you issued in the current year, include that in last year also. Because you are reporting last year to the shareholders, include that in last year also. Because these shareholders won't understand the logic why the EPS has gone down. So you include the effect of bonus shares in both the years. Now what will happen? Last year also if you include the bonus shares, EPS will go down. Compared to that, this year's EPS will be more. So correct information about the profitability of the company will go to the shareholders. So what you are supposed to do is that if bonus shares are issued by the company, if bonus shares are issued by the company, you are going to include that from the earliest period reported. Write down this note in your notebook. Bonus shares will be included from the earliest period reported. Means if company reports the information for last 5 years, 15, 16, 16, 17, 17, 18, 18, 19, 19, 20. Any bonus issued in 1920 would be included from 15-16 onwards. In between, any bonus issued from 17-18 will be included from 15-16 onwards. Whatever period of your financial information you are reporting to the shareholders, include the effect of bonus shares from the very first period so that the wrong impression about the trend of profitability does not go amongst the shareholders. However, if you are reporting only for the current year, then in the current year, which is the earliest period reported, date of opening of the year, beginning of the financial year. So if bonus shares are issued in the current year, then you include it from the beginning of the year, irrespective of whatever date it is issued. So even if it is issued on 1st October, you take from 1st April. Even if it is issued on 1st January, you take from 1st April. So you remember this point, bonus shares have to be included from the earliest period reported. Why? Because if bonus shares are issued, profits don't increase, numerator don't increase, number of shares increase, denominator increase, so EPS goes down. In a way that the wrong impression does not go amongst the shareholders, we include the bonus shares from the earliest period reported. So if you are reporting the information of last 4 or 5 years, include it from the very first year which you are reporting. If you are reporting only current year, include it from the beginning of the year. So very important note, everyone must write it down. Okay. Second point, what you will remember, if there are partly paid shares, they should be included as if they are fully paid up. Why? Understand it. Suppose we have 2 shares. 20,000 shares of 10 each fully paid up. Means 2 lakh rupees company has received. 20,000 into 10. And we have 20,000 equity shares of 10 each 5 paid up. Means 1 lakh rupees company has received 20,000 into 5. Now here you are receiving 2 lakh rupees, investing 2 lakhs in the business. So your profits are going to increase according to 2 lakhs invested. Here you are receiving 1 lakh rupees, investing 1 lakh in the business. So compared to that 2 lakhs, the profit will increase but little less because only 1 lakh gets invested. Now again the same concept like bonus. In the numerator, the profits increase more due to 2 lakhs, less due to 1 lakh. But in the denominator, you include 20,000 plus 20,000, 40,000 shares only, then again the EPS will go down. So what they say is that this 20,000 shares which are partly paid up, what is the amount paid up? 20,000 into 5, 1 lakh. If they were fully paid up, 10 rupees full paid amount, then they would have been equivalent to how many number of shares? 1 lakh divided by 10, 10,000 shares only. So in the denominator, you don't include 20,000 plus 20,000, 40,000 shares. You include 20,000 plus 10,000, 30,000 shares only. You understand the logic? 20,000 shares, you are investing 2 lakh rupees in the business. So profits will have more effect on it. Another 20,000 shares, 5 paid up, you are investing only 1 lakh in the business. So it will have lesser effect on the profits. So in the profits, the effect is not equal to 20,000 shares. You are investing 1 lakh rupees, means in the profits, the effect is only equivalent to 10,000 shares. So in the denominator, you don't take 20 plus 20, 40,000. You take 20 plus 10, 30,000 shares only. Look at it once again and write it down in your notebook. If there are partly paid up shares, they should be included as if they are fully paid up. Okay, 20,000 into 5 paid up, 1 lakh. As if they are fully paid up, they are equal to how many number of shares? 1 lakh divided by 10, 10,000. So apply this formula, write this formula in your notebook. Number of shares into paid up value divided by face value. Like number of shares 20,000 into paid up value 5, 1 lakh divided by face value 10, 10,000 shares. Okay, 20,000 number of shares into paid up value 5, 1 lakh rupees is paid, divided by face value 10. So this 20,000 shares are equivalent to 10,000 fully paid shares. So whenever there are partly paid shares, we will apply this formula and then we will include the number of shares in the denominator. Okay. And the last point is regarding if the company has 2 different face value shares in the company. If there are shares with different face values, let us say 20,000 shares of 10 each and 20,000 shares of 8 each. 20,000 shares of 10 each and 20,000 shares of 8 each. Now, again, 20,000 shares of 10 each means you are investing 2 lakhs. 20,000 shares of 8 each means you are investing 1,60,000. So profits will have more effect of 2 lakh and less effect of 1,60,000. But in the denominator, we cannot include 20 plus 20. So same concept. You take as if all the shares are of 8 rupees or all the shares are of 10 rupees. So if shares are with different face value, then number of shares should be adjusted as if they are of same face value, preferably 10. So that 8 rupees shares you convert into 10. Means 20,000 shares into 8, 1,60,000. If they are 10 rupees shares, they would have been equivalent to how many shares? 1,60,000 divided by 10, 16,000 shares. So in the denominator, we'll take 20,000 plus 16,000, 36,000 shares instead of 14. So if shares are with different face values, then number of shares should be adjusted as if they are of same face values, preferably rupees 10. So any other face value, 8, 5, 15, 20 rupees shares, you convert them to the shares as if they are of 10 rupees. And accordingly, you adjust the number of shares. If they are less than 10 number of value of shares, like 20,000 into 8, 1,60,000. So then 1,60,000 divided by 10, the number of shares will decrease 16,000. And if they are more than 10 rupees shares, then the number of shares will also increase. Let us say if 20 rupees shares, we have 20,000 into 24 lakhs. If they are of 10 rupees, 4 lakhs divided by 10, 40,000. Then you don't take 20,000 shares, you take 40,000 shares. So you adjust the number of shares, you increase them or decrease them, considering as if they are of 10 rupees only. Okay. So these notes you have to remember when we solve the practical questions. All the basic concepts of basic EPS we have covered in this lecture. In the next lecture, we will take up its practical questions. All of you revise the summary very well again. All of you must have written these notes and every formula what I have made you write today and the table, etc. Revise that properly. In the next lecture, we will start with its practical questions. Bye everyone. Take care. See you in the next lecture.